year 1. The year is starting. First, have a clear understanding of when the financial year is starting. That is on 1/1/2000 and it ends in 31st 12/2000. Exactly 12 months. Right? Year 1, that is on 1/1/2000. They had a motor vehicle. They bought a motor vehicle costing 120,000. Right? Again, on 1/6/2000, they bought another motor vehicle for 50,000. So overall, the business is having a total of 170,000 worth of a motor vehicle. But the problem here is they have given a note, consider depreciation from the date of purchase of non-current asset. Now when you observe this, you can see the first one, this one, we can give 1 year's depreciation. Why 1 year's depreciation? Because you have purchased on the starting year of the financial year, that is 1/1/2000. So you don't have any problem with calculating depreciation for motor vehicle which was purchased on 1/1/2000. But there is an issue when you go to calculate for this one, 1/6/2000 motor vehicle 50,000. So first let's calculate for motor vehicle 1. I'll just mark it motor vehicle 1. So we are going to calculate for the financial year 1/1/2000 to 31st 12/2000. For the first motor vehicle, I am calculating which is out of 120,000 into, we'll assume that the percentage of straight line method is 10. So let's calculate, that will be 12,000. So no issues with calculating for the first motor vehicle. But when you calculate for the second one, they made the purchase on 1/6/2000. The financial year ends in 31st 12/2000. This is for motor vehicle 2. How much is motor vehicle 2? 50,000. 50,000 into the percentage will remain same, 10%. That is equal to 5,000. Now we know the overall depreciation for the first financial year, which is 17,000.
The second one, you calculate for the entire year.
Yes. So this 5,000 cannot be for one entire year. So purposefully I have made this mistake. How many months here? From 6 to 12. So count. It's the beginning of the month. 6, 7, 8, 9, 10, 11, 12. 7 months. So this 5,000 cannot be written here. You have to make an adjustment. So let's see how to calculate that. Because it is existing only for 7 months with the business. So 7/12. Now let's calculate 5,000 into 7/12. So approximate answer of 2,917, because we do not write decimals. So here 2917. Overall it will be 14,917, the total which should be considered as depreciation. Value here, over here, into 7/12, so that you can directly get the answer. Now for year 1, that is 1/1/2000 to 31st 12/2000, the value of depreciation is 14,917. 14,917. Now calculate for the second financial year, because they have asked you to calculate for 3 financial years. So next one, 1/1/2001 to 31st 12/2001. The question doesn't specify any purchases taking place during this financial year. So what is the total amount of non-current motor vehicle you have is 170,000. So 170,000 into 10/100. 10%. So that will be 17,000. This is for the second financial year. 1 is done, 2 is done. Now we have to calculate for the third. Now let's calculate for the next financial year. That is 1/1/2002 to 31/12/2002. Here also they didn't specify any purchase or sale of any non-current asset. So 170,000 into 10%. That will be again 17,000. So end of the third year, you will have a total depreciation of 7,197 plus 7, 14 plus 4 is 18.
48.
Yes, remainder 1, 2, 3, 4. 48,917 at the end of third year, which we can also say the total depreciation at the end of the third year. Now let's prepare a T account. I'm writing accumulated provision for depreciation. Depreciation is a provision, therefore the normal balance will appear on the credit side. So 1/1/2000 is the year period it's starting, and they didn't have any depreciation at the beginning of the year.
Okay.
But we calculated for the end of the year a total depreciation which is 14,917. So 14,917 will go to income statement. Now let's balance this off. Take the total 14,917, 14,917, 14,917, carry it down 31/12/2000, 1/1/2001, brought down, balance brought down 14,917.
You're making.
Now let's go to the second year. Second year, the amount that we have calculated is 17,000 for the second year. So write 31/12/2001 income statement of 17,000. Let's balance this. 7, 1, 9, 7 plus 4 is 11, remainder 1, 3. 31,917, 31,917, 31/12/2001, bal carried down, 1/1/2002, bal brought down, which is 31,917. Now let's calculate for the third year. Third year, it is 17,000 back again. So 31/12/2002 income statement 17,000. Let's balance this. 7,1,984. So 48,917, 48,917, 31/12/2002, bal carried down, 1/1/2003, bal brought down of 48,917. Now let's see how to post this to an income statement. I'm classifying the income statement into 3 different years. For 2001, 2002, 2003.
It's 2000.
Sorry, it should be 2000, 2001, 2002. Right, motor vehicle depreciation. For the year 2000, the motor vehicle depreciation to the income statement is 14,917. So 14,917. And for the second year, it is 17,000. And for the third year, again, it will be 17,000. Now let's see how it reflects in a SFB. This also I'm classifying into 3 different years.
So when you
Fine. For the first year, the total amount of non-current assets were 170,000 in total. Next year also it's the same. They didn't buy or sell anything. Even next day it will be 170,000. Depreciation for the first year will be this 14,917. 14,917. And for the second year, it will be this one, 31,917. 31,917. And for the third year, it will be 48,917. 48,917. Now you deduct this and you will find the net book value.